And as Greece's finance minister resigns after just a few days on the job and optimism for this week's European summit fades, the Greek stock market tanked today, falling 6.8%. National Bank of Greece led the declines, falling more than 13%. Let's bring in some names to help us sort it all out. Scott Bauer has been trading all day in the pits of the CME Group. Scott Black says the situation in Europe is dismal, and yet one single step could reverse the nightmare. But Mark Martiak says regardless, the U.S. is really a beacon of opportunity. There is still growth ahead of us. So let's start with Scott Bauer at the CME Group. And so the markets, as you know, are down today after Spain made it official. It stopped pretending Spanish banks didn't need a bailout and said, you know what, we actually do need about $125 billion right now. Does this mean the entire investment planet remains totally hopeless, or can you make money? Well, you know the answer to that. You can always make money. Scott Black is the president of Delphi Management. He's making money. So is Mark Martiak. He's the vice president of Premier Financial Advisors. Welcome to you both. All right, are you in or are you out? Scott Black, you start.
Well, we try not to time the market. The old Warren Buffett, we can't time it. We try to buy good businesses. And there are a lot of good businesses now with very high returns on equity selling at the lowest PEs they've sold at in years. Doesn't mean they're going to go up next week or the week after, but if you had a 3 to 5 year time horizon, these are terrific entry points. And two in particular are powerhouse tech stocks. Qualcomm, which has gone down here, it's selling at roughly 10 times earnings net of the cash. It's a legitimate 13 to 14% grower. And one we just started buying, it's here in Hopkinton, Mass, which is EMC. You get VMware, which is a 22% grower, which is owned 80%. And the company overall will grow at about 11% top line. It's selling roughly at 12 times the coming year's earnings. Right. So these are powerhouse franchises at very low multiples. I mean, they're below a market multiple. A market multiple today closed at around 12.7 times expected earnings.
Well, Mark, when you look at, for example, Qualcomm, which of course is one of his picks, and I know you pick more sectors, but that PE, first time in a long time we've seen it at 9. Is this market affordable to the point where you can afford not to be in there?
I couldn't agree more. This market is highly affordable right now, and I'm advising my clients to focus on tactical opportunities and as well as defensive sectors. So I'd like them to be looking at healthcare at this point, consumer staples, telecom, utilities, and don't forget fixed income for the stability and the reliability, in particular the municipal bond asset class. It's a risk-on, risk-off market. It's a headline risk market. Today, it was risk-off. I'm referring to it as a row-row market, but I'm also telling my clients, high net worth and ultra high net worth clients, individuals and families, stay poised, stay very focused, don't panic. Everything is going to be okay. We're climbing a wall of worry, but it all depends on what day it is. But we can make money, and I'm highly confident about it.
Scott, we had a guest in here last week who said that every time a headline comes out of Europe and the market falls, he calls it, one of his traders calls it a tape bomb, meaning it hits the tape and the market just bombs. So, part of this issue is solving the European crisis. They're going to have a meeting on Thursday. I don't know if you believe anything's going to happen, but you've said there's one opportunity here to turn the European doldrums around. What is it?
Yeah, it's unlikely. You should have the ECB get together, and obviously you're going to need the consent of Germany and Angela Merkel, and backstop it by issuing sort of quasi-Nicholas Brady bonds. What we did back when Brady was the Secretary of the Treasury for Brazil and Argentina. You restructure the debt, you back it with the ECB, you have lower interest rates, you might have to take a haircut on some of the principal. I think this is the only way out. And you can't have totally austerity types of measures, because if you have a deficit to GDP of 5 or 6%, you're already negative. If you cut 3%, you really sink the economies. So it has to be a balance of austerity, refinance, and some pro-growth objectives. But it really all hinges on what the Germans think.
Yeah, it sure does, Mark. I mean, you were nodding this idea of austerity. It's not working. You saw what happened in Greece. You see the massive pushback. Doesn't mean that eventually they won't have to come to realistic terms here about spending less than what they're actually taking in. But this is, you cannot deny it, affecting our market. So what do you tell your clients? Tune it out every time your stocks that you pick get a hit?
I always tell them to tune it out, to be honest with you, because every day it's a different headline risk, it's a different story. So I just tell them to stay focused, listen carefully, don't be fearful, don't panic sell, and in fact, to be able to mitigate the risk, let's buy on the dips when we need to with that tactical portion of our portfolio.
Well, you were saying some defensives were consumer staples, telecom, healthcare. What's your one growth sector?
My one growth sector continues to be technology. Now, again, it's a high beta sector, meaning that there's a lot of risk, but the reward is also commensurate with the risk. And it all depends on each individual investor. Every client has a different risk reward objective as well as profile.
Okay. I wanted to get Scott's last pick in here, Triangle Capital. So what is it about this company? Because you are a master stock picker. You're part of the Barron's Roundtable. I always listen closely when you make certain picks, Scott. What is it about Triangle?
Well, what's nice, it's a business development corp. It's under-leveraged here because they've raised money. The net debt equity is 0.34. The price to book is about 135. And the earnings are growing nicely with the loan portfolio. Plus, you're going to get paid while you wait. We bought the stock under 20, but it's got a $2 dividend, so you still get a 9.5% current yield. They've increased their loan portfolio 20%. It's mezzanine financing, but they've been very strict. And even in the downturn in 08 and 09, they had very good results. They didn't have much in the way of loan loss reserves that they had to take because they didn't screw up too badly. So if you want to get paid while you wait and you want a growth entity, I think TCAP is probably a good stock with a 9.5% yield.
Hey, we like yield. That's a good one. Hey, gentlemen, thank you so much. We appreciate it.
Thank you.
Solid investment advice. And, you know, when you listen to Mark, he's talking to his high net worth clients, saying, stay ready, stay poised, stay calm. Mark Martiak and Scott Black, thank you so much.
Thank you.